Now let's turn our focus to some specific budgeting problems. If you'll turn in your lecture notes, we'll get started. In this problem, we're going to look at the direct material, direct labor, and manufacturing overhead budgets. Frisco Company is preparing its master budget for next year. Relevant data pertaining to its sales activities are: so in January, we're going to sell 2,000 units, February 3,000, March 4,000, and April 3,000 units. The selling price will be $50 a unit for January, February, and March, and $52 per unit in April. Management desires to continue to maintain ending finished goods inventory equal to 20% of the next month's expected sales volume. Each unit requires 1/2 pound of raw material, costing $4 per pound. Frisco began the year with 500 pounds of material, but management wants to implement a new policy that requires raw material inventory at the end of each month to be equal to 50% of the direct material needed to meet the next month's production requirements. Each unit requires 2 hours of direct labor at $12 per hour. Assume direct labor is guaranteed to be paid 5,000 hours each month. Any hours worked beyond 5,000 hours will be paid an overtime premium at a rate of 1.5 times the regular rate. The variable overhead rate is $3 per unit, and total fixed overhead costs of $14,000 are expected to be paid as incurred each month. In addition, monthly depreciation for the factory equipment is expected to be $1,000. So here you're given information first about material requirements, then labor, and then overhead. First, we'll focus on the direct material budget. Prepare a direct material purchases budget for the first 2 months of the year. Now what we're given is, for January, February, March, and April, we're given sales. So if we're given sales, before we can do a direct material, direct labor, or overhead budget, we are going to need to prepare a production budget, because your materials usage will be based on what you produce. So your production budget, I have a column here for January, February, and March. Now we're only doing the materials budget for the first 2 months, but as you're going to see as we move on, we're actually going to need to know production for the first 3 months. We were told sales in units would be 2,000 for January. Then we're going to add desired ending finished goods. And our policy is 20% of the next month's sales. So we want 20% of 3,000 units at the end of January. Then we'll subtract our beginning finished goods, which will be 20% of 2,000, because you want to begin January, that is end December, with 20% of what you need to sell in January. So that will be 400 units. Your production then will be 2,200 units in January. In February, you're told that you will sell 3,000 units, and you want to end February with 20% of what you're going to sell in March, which is 4,000 units given in the problem. So you want to end February with 800 units. Now beginning inventory for February would have been ending inventory in January. So we can just move that 600 down into the beginning inventory for February, and we will then produce 3,200 units in February. In March, you're told that sales are 4,000 units. You want to end with what you're going to sell in April is 3,000 units, and you want to end March with 20% of that, or 600. Your inventory at the end of February will become the inventory at the beginning of March, or 800. So production in March is 3,800 units. So if you'll notice, in order to prepare a production budget for March, you needed to know sales for April. You have to look ahead. Oftentimes companies will look ahead to determine how much inventory they want to have, because when they have seasonal fluctuations, they don't want to stockpile inventory if production or sales are going to be lower. Now that we've computed production, we can compute our direct material purchases budget. What we were told initially about raw materials is that every unit requires 1/2 pound of material that costs $4 per pound. So we're going to do this for the first 2 months, but as you'll see, we do need to look at the first 3 months, at least initially. Production is 2,200 units in January. We just computed that. We computed February production to be 3,200 units and March 3,800 units. We know that each one of these will require 1/2 pound. So your total direct materials required in production, sometimes called materials production requirements, will be 1,100 pounds in January, 1,600 pounds in February, and 1,900 pounds in March. All right, that tells us what we're going to need in production. But of course, to figure out what to purchase, you will have to consider if you already had some materials at the beginning of the period and if you want to end with materials at the end of each month. So we will add desired ending direct material. That will give us the total materials required. Then we'll subtract beginning direct material to get direct material purchases. All right, so all this is saying is you figure out what you're going to use, then you figure out if you want to end with some materials, you'll have to buy them. If you already started the month with some materials, you don't have to buy them. All right, so here's what we were given in the problem. We began the year with 500 pounds of material, but management wants to implement a new policy that requires raw material inventory at the end of each month to be equal to 50% of the direct material needed to meet the next month's production requirements. All right, so using that information, we can compute ending direct material. In January, that is going to be 50% of what you're going to use in February. So 50% of 1,600 is 800 pounds. We need a total of 1,900 pounds in January, but we began with 500 pounds. That was given in the problem. So we will need to purchase 1,400 pounds. Then in February, you're going to want to end with 50% of what you are going to use in production in March. So now you see why while we were asked to prepare January and February's budgets, we did have to go ahead and prepare at least part of March so that we could find ending inventory of raw material for February. Total direct material required is 2,550 pounds in February. The 800 pounds we ended January with is what we'll start February with. And so our materials purchases will be 1,750 pounds in February. Now that we know how many pounds, the purchasing agent can go and find the best vendor for that. And we estimate, if you'll recall, that materials will cost $4 per pound. That was given in the problem. So we'll multiply the purchases by cost per pound of $4, and we get materials purchases in dollars of $5,600 in January and $7,000 in February. So a lot of computations, different numbers are needed by different managers, but ultimately our budgets are in dollar amounts. All right, so we've completed our direct materials budget. So now we'll focus on direct labor. What is the expected cost of direct labor for the first 2 months for Frisco? The information that was given originally in the problem about labor says each unit requires 2 hours of direct labor at $12 per hour. Assume direct labor is guaranteed to be paid for 5,000 hours each month. Any hours worked beyond 5,000 hours will be paid an overtime premium at a rate of 1.5 times the regular rate. So first we'll figure out what is the minimum labor cost that we're going to have. And what we're told about the minimum direct labor cost is that labor is guaranteed to be paid 5,000 hours. Companies will do this in order to maintain their labor force. They don't want their hours to vary so much that they go looking for other work. So we know at a minimum in both January and February, the minimum hours is 5,000, and we pay our regular labor rate of $12 an hour for each of those 5,000 hours. So at a minimum, labor cost in January is $60,000 and February is $60,000. Now we'll need to add to that any overtime premium. So in order to figure out the overtime premium, we need to remember that after 5,000 hours, direct labor will be paid an overtime premium at a rate of 1.5 times the regular rate. So we first need to figure out how many hours are actually going to be needed in both January and February. Production in January is 2,200 units. Production in February is 3,200 units. That was computed in Part A when we prepared the materials budget. Notice that production feeds into the direct material budget, the direct labor budget, and it will feed into the overhead budget. Now we'll multiply by the direct labor hours required per unit, and we're told that that is 2 hours per unit in both months. So in January we need 4,400 hours, and in February we need 6,400 hours. Now we'll compare that to the minimum. At minimum, we'll pay for 5,000 hours in both January and February. Now we can see that in January, when we compare the hours needed to the minimum, we see that we will pay no overtime hours in January. But in February, we'll pay 1,400 overtime hours. We'll take these overtime hours and multiply by the overtime direct labor rate, which is 1.5 times the regular rate, or 12 times 1.5 is 18. So just these overtime hours are paid the extra amount, and so our overtime pay in January will be 0, and in February it will be 1,400 hours times $18, or $25,200. Now we can figure out the total pay, now that we know what is our minimum and what overtime pay will be paid in each of the 2 months. So for January and February, we'll take our minimum cost of $60,000. We'll add to that our overtime pay, which is 0 in January and $25,200 in February. Total budgeted labor cost in January is $60,000 and in February is $85,200. So this gives us a closer look at the labor budget with a complicating factor that some companies will have to consider, and that's minimum hours that we will pay our labor force. Now we can turn our focus to overhead. What is the total expected manufacturing overhead cost for the first 2 months? What we were told in the original information about overhead, shown in the latter part of the paragraph, is that the variable overhead rate is $3 per unit, and total fixed overhead costs of $14,000 are expected to be paid as incurred each month. In addition, monthly depreciation for the factory equipment is expected to be $1,000. So we're looking at this for both January and February, and we're going to focus on the variable overhead first, and we notice that the variable overhead rate is $3 per unit. Now, since it says $3 per unit, we'll have to start with our budgeted production, which we computed earlier in Part A. We determined that we would produce 2,200 units in January and 3,200 units in February. Our variable overhead rate is $3 per unit, so we'll multiply these units by $3. Now notice that in other problems your variable overhead rate might be per direct labor hour, and in that case you'll multiply by direct labor hours. Or it might be direct labor dollars. In that case you'll take your rate times direct labor dollars. You do have to be careful of how the company expects to incur variable overhead cost. Our total variable overhead cost in January will be $6,600 and in February $9,600. Now we'll turn our focus to fixed overhead. Let's remind ourselves of what was given in the problem. Total fixed overhead cost of $14,000 are expected to be paid as incurred each month. In addition, monthly depreciation for the factory equipment is expected to be $1,000. So to get the total overhead expected, we will add the out-of-pocket fixed overhead and the factory depreciation. Both of these are expected overhead costs, and they occur in each month. So we'll add $14,000 in each month for the out-of-pocket or paid as incurred fixed overhead costs. This would be for factory rent or factory property taxes. And then we'll add the depreciation of $1,000 for each month to get our total budgeted manufacturing overhead. So if we add our variable overhead of $6,600 plus our two fixed overhead costs of $14,000 and $1,000, we'll get $21,600 of total overhead for January. For February, it's $24,600. Now, oftentimes you'll want to get the total overhead expected, but you will also want to get the cash disbursements for overhead. So in order to do that, you will have to take out the non-cash expenses. So now we'll turn around and subtract out the factory depreciation. $1,000 in each month. So our cash payments for overhead will be $20,600 in January and $23,600 in February. So again, with your overhead cost, you're going to want to compute both the total to be incurred and the cash that will be paid out for overhead. Now, for a company, they'll prepare both of these. If you're wondering what will be on the exam, I will ask for one or the other. What is the overhead expected to be incurred? January, $21,600. What are the cash payments for overhead in January? $20,600. So I'll be very specific. All right, that concludes the focused problem on direct material, direct labor, and manufacturing overhead budgets. These are of course, your production costs. See you next time.